Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Friday, June 9, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And it was a pretty wild day on Wall Street today around the market. So for example, you see here while the S&P is only down around the close about 25-30 cents, it had a pretty wide-ranging day, and that's really not the tail of what happened today. The S&P is not necessarily the tail of what happened, and we're going to get into more of what the tail is in a couple of minutes. But on close today, basically what we have is an S&P that just continues to go sideways. We tried to pop a little higher this morning. We dumped out in the middle of the day. We took a pretty big decline, and I'm going to show you that in a minute. And then we rallied back to close very close to the flat line for the most part, okay? But on the daily chart, it doesn't look like anything happened. All we're doing is going sideways, and this is essentially setting up for another push higher. But let's dig down a little bit deeper. When you look at the intraday chart, you can see pretty nasty rollover today and a waterfall decline. So when you look at the 60-minute chart, whoops, that's not the 60-minute chart. When you look at the 60-minute chart, you can see here where we found support was in the former consolidation point, the top end of the former consolidation. This would also qualify as the breakout area. So we consolidated, took a little dip down, but then we broke out when we closed above the former consolidation point, and that's where we came back to test today. So if I were to just draw a line in around today's lows, you can see here that we came back in to test the former consolidation point. I like to say we came back to check in at the breakout point. It's also known as the scene of the crime. Around 242 is that number. And so that was a pretty large decline from where we were early this morning up at 245. We got as high as 245.01, and we declined 30 S&P handles or 3 points on the SPY. That's a pretty big decline, and we finished pretty close to the flat line. So if you looked at the market from yesterday's close to today's close and just looked at the daily chart and you really weren't paying attention to the big wicks on either side of this candle, you would say, oh, down 30 cents. Nothing happened today. Yeah, move on. And you would be right in large part, but there is a tale to be told today, and let's get into that a little bit. And I find it wildly interesting, the tale today. So right out of the gate, you had the IWM screaming higher. Let's go to the intraday chart. Not that one. You'll see here up until 11:50 in the morning, the IWM was relentlessly running higher. Going back to the daily chart, you'll see what we did was we found resistance we pierced through and found resistance at that same trend line that we've been watching for a couple of years. Look at it over from the monthly chart, and you can see here we pierced through it again today after having pierced through it 2 months ago and being rejected in the month of June, now coming back up to retest that line. We're riding this line. There's most likely higher prices to come, but remember what we've been saying, that the IWM was the lagging indicator for a while, and I said these indices have a way of self-correcting, and in doing so, the one thing or the other was going to happen. Either the SPDR, the S&P 500, and the Dow was going to come back down to meet the lagging nature of the IWM, or the IWM was going to play catch-up on the upside and meet the Dow and the S&P where they were near their highs. And that's what we saw happen today. We saw the IWM make new highs. And I find it fascinating. It should come as no surprise. It's not like we knew that that was going to happen from yesterday to today, but the point is that we knew that the indexes or indices weren't going to stay diverged for a long time, and one had to catch up with the other. The S&P was hanging around the all-time highs, And over the last few days, we saw the IWM begin to catch up. And here it is, played catch up and caught up to the S&P. I find that interesting nonetheless. But then, once we hit that high, the IWM backed off, still finishing up 0.5% for the day. But what I want to notice is, and we're going to backtrack for 1 second while I do this, look at the volume today. The volume on the IWM was 55 million shares, about twice, not quite, but almost twice the daily average volume. The SPDR was 120 million shares, significantly more than the average of less than 74 million shares. So that's interesting information, okay? It's interesting for a couple of reasons because, A, we haven't really unpacked the full scope of what happened today underneath the hood of the market, and we'll get to that. But the other reason is because it's a Friday leading into the summer months. Generally speaking, not a lot going on. The market started out relatively quiet, and then the volume picked up, and you can see here, let me go back to the intraday chart, and you'll see the volume picked up, not out of the gate. Here's out of the gate. The volume's down here. It's nothing, right? And then as the morning went on and the afternoon went on, the volume went heavier and heavier and heavier as the sell-off came worse and worse and worse. And then we finished the day, obviously, with decent volume in the last candle of the day. We usually do. And then at the end of the day, the volume was relatively significant. Okay, so where am I going with all this? So we had a relatively flat day in the SPDR at the end of the day, still making a bullish consolidation pattern. The IWM hits new all-time highs and backs off. Maybe it needs to pull back. Maybe it's overbought in the short term. That's fine, but we can certainly consolidate in this upper range to move higher. Okay, so it's positive that the IWM rallied higher, made new highs, but backed off, but it's still in a bullish position. Okay, the SPDR is in a bullish position. And now what you have here is, let's go to the VIX. The VIX was down all day, was in the 9s, okay, made a low today, all the way at 937, and then this afternoon made a high at 1211. That's a pretty wild 30% intraday swing in the VIX, I'll say. Okay, that's interesting nonetheless, but that's not really where the action was. We're getting there. The transports were flat. They continue to go in a bullish sideways consolidation pattern, look very much like the SPDRs. So no new information in the transports. So we have the SPDRs bullish, the IWM rallied to new all-time highs, backed off, but is in a bullish position. The transports, nothing happened, continues to be bullish. The VIX had a wild swing today, understandably speaking, since we had a wild swing in the markets, but the VIX made new lows today, or in the 9s. That was low. I don't know if it was a low. I'm not going back there to find out. It was very low. Okay, and then here's where the action was. Look at the NQ. This is where the market is talking to us. Whether it's something imminent or not remains to be seen. But this is the first shot across the bow, I think, leading up into the summer months, since I do think that a more prominent turn is upon us, not necessarily here today, but will be upon us in a matter of weeks. I think this was a distribution day for the NASDAQ, and the NASDAQ was down a tremendous 238-point intraday swing on the NQ. And here's why. It's a top-heavy index. Now let's dig deeper. And we've been talking about this, and I've been talking about this for a very specific reason, and this is it. So the NASDAQ finishes down 2.5% today. That's the NQ. It's very top heavy. The NASDAQ composite was down 1.8%. Let's just bring that up just so you can see it. I don't talk about it hardly at all, but just so you can see the composite. It looks the same, but that was down 1.8% today, 104, almost 114 points. But the NQ is the Futures 100 contract, the NASDAQ 100 futures contract, and it's top heavy, and here's the reason why. Amazon today, down $32. Apple, okay, down $6. Google L, down $32. Netflix, down $7. Facebook, down $5. They all look the same. All the charts look the same. This was everybody running for the doors at the same time. And this is what I've been warning about with the overweighted FANG stocks, the top-heavy index, where everybody, all the hedge funds, all the mutual funds, all the individual investors, everybody owns in one way, shape, or form that is invested in the market through funds, mutual funds, pension funds, money managers, whatever it is. Most people have exposure to the stocks I just mentioned. The Facebooks, Google, Amazon, Netflix, Apple, and so on. Okay, here's another one today that was just a tremendous, unsustainable move and a tremendous decline today in NVIDIA, down $10. But here it is. From high of 168 to low of 142. Okay, intraday, that's just a tremendous, after a gap higher, it's called a gap and crap. When you look at a chart like this, this is a gap and crap. This is a trend change signal, obviously. Okay, this is what we talk about. This is an engulfing candle. It's a reversal candle. It's a change in character. It's a trend change. Any way you want to slice it, it's a change in this market, meaning NVIDIA, and the other stocks had a similar effect today in the NASDAQ top-heavy related stocks. So A, that's the reason why I don't use that as a leading or lagging indicator of the market, is because of the quote-unquote top-heaviness of the index, and it's represented in large part by those top 4 to 6 stocks. And the other thing is, you want a broad representation of what's going on across the market, hence, which is why I use the IWM. It's even more broad of an index than is the SPDR. The SPDR can even be termed top-heavy to some extent because it is top-heavy to the largest names in each sector or individual group of stocks: energy, financials, consumer discretionary, utilities, and such. So it is top-heavy in terms of those weightings, as is most of the indexes. However, we want a broad representation, and we get it more so in the IWM. So that being said, this could be a shot across the bow. Now let's go back over to, in fact, better yet, let's look at the Qs. Okay, that's not the Qs. Let's look at the Qs. I can't talk and type at the same time. It never changes. Okay, so here are the Qs, and you can see the volume. And by the way, the volume on the other stocks, I'm not going to go back, and I'll just tell you that each of them were about 2 times their average daily volume. So not only do we get supported by the look of the chart and the intraday swing and the gap and crap and all that stuff, but we're also supported by the fact that we had volume today. That's a reversal. It's bona fide reversal day in those stocks. Same goes for the Qs. Look at the Qs with 107 million shares against an average daily volume of 24 million shares. This is a reversal day that took out, by the time we closed, we took out 2 weeks of upside. Intraday, we took out 3 weeks of upside. So that's a big deal. We need to pay attention to this. It's a shot across the bow. Usually, from a situation like this, a big down day like this, you'll get some sideways, bearish consolidations start to develop, some retracements. It looks like retracements. It looks like a recovery, but it turns out to be bearish consolidation. So that's what we're going to be watching out for early next week. Here are a couple of situations that you can see pretty clearly where we saw a pretty rapid recovery from situations like this, where the market just shook a day like today off. This was a bigger one than these were. We'll see if it has the capability, meaning the market, to shake off today, and if we just continue higher into the end of this cyclical period. We'll see. But all in all, under normal conditions, this is a shot across the bow and needs to be paid attention to. But we do have divergences, right? So obviously the NASDAQ is still diverged from the other markets, only it's on the downside now, right? The IWM is at highs. NASDAQ had a terrible day. And then what do we have here? We have the broker-dealer index up almost 2%. So the financials are screaming higher. The S&P is basically flat. The Dow finishes up 89 points. Forgot to make mention of that, okay? Nasdaq's down 114 points on the composite, and the broker-dealer index is up almost 2%. What do you do with that? So we need more information. We have divergences out here, and we need some activity next week to get these markets back in sync. We're not going to take a guess. We have a lot of pieces to the puzzle on the table right now, but they're not connecting together. And when that happens, when the puzzle pieces are not connecting together, you just have to wait for more clarity, more puzzle pieces to come onto the table, and they'll start to connect soon enough, whether it's Monday or Tuesday or Wednesday, whatever it is, they'll start to connect back up. But right now, we have an interesting day, and we're not going to pass judgment right away. We need more information, and we'll see that early next week for sure. All right, going over to the gold market. Let me be Captain Obvious and state another down day in gold today. We were down $10. We're coming into the convergence of the 50 and the 20 period moving averages, the red and blue trend lines. We didn't quite get there today. However, we're close enough. We're a stone's throw away. We'll probably get down there on Monday, if not sooner, potentially Sunday night. This is working off an overbought condition number one. Could be just a pullback, and we could absolutely race higher again. That's certainly possible. This could be, the makings of an ABC pattern, for example. So if you look at ABC pattern, we have potential A, B, wherever it ends, and then another C leg higher. That is possible. If we break below the moving averages, then something else is most likely developing, and that would be on a closing basis, on a daily chart closing basis. We could probably tolerate a close below the 50 and the 20, but any close below the 200 period moving average, and most likely something else is developing. However, on the flip side, talking out of both sides of my mouth, we could have a normal garden variety retracement coming down to right in this general zone. That would be about a 50% retracement, which is normal garden variety. And what that would do is it would put the, and let me just show this to you. I'm eyeballing it, but I can see it as clear as day, but I want you to see what I'm seeing. So rather than me assuming you see it, let me draw it out. So if I did a fib retracement, your 1258 general area is your 50% retracement. So let's put a line at 1258 and see what we have and why that would be important. Okay, 1256, 1258. Okay, so 1258. So it just so happens to be close to the bottom of this large up green candle that started another breakout zone. Okay, that's not the most important thing. It's not of the utmost importance, but it's something to hang our hat on. Let's move along. It's something. This is a consolidation zone in here, so the market thought that this, I'm not going to say this zone was 1258, but we seem to be in the middle of this consolidation zone. So I'm going to chalk that up on the bullish side and say, if we retraced into that zone, that's still meaningful. It's an important area. Okay, here's another consolidation zone for quite a while. We consolidated around this number for quite a while. So that's another case to why we would find support if we came back in to retest that 1258 zone. Maybe it's 1260, maybe it's 1256. But I want you to get the general gist of where I'm going with this. And then here, while we overshot it a little bit, you can see how this general area, once again, even here, a higher or a lower high, this is probably 1254 or 1252. This general area is important to the market. So as we come back down to retest this area, the fact that it's a 50% retracement, the fact it's in between the moving averages, the fact that it's coming into former consolidation points where the market was telling us that that price point or zone was important. All these are evidence that points to a reason why you would be looking for or could be looking for a possible long side trade in and around that area if you saw the right setup. If you saw an intraday, if the gold market was trading intraday and put in the type of pattern that we would like to trade off of, an intraday bullish consolidation pattern, an intraday doji candle on an hourly chart into that zone, something of that nature, That's what we're looking for. And the reason why I spent so much time on this is it's not a gold chart. It's just a chart. It could have been anything. I just wanted to describe the thought process of how I look at a chart. I look at a chart as a canvas. There's stuff on the canvas, and this is how I visually and mentally unpack what I'm seeing on the chart to decide whether it's something I would be interested in looking at for a trade as we come into the next several trading days. The answer on gold is yes, so it goes on my list of stuff I'm watching in the near term because I would be interested in and around that 1258 area given the right market conditions. And therein lies the reason why I went through all the detail of what I just did on this chart. Had nothing to do with the fact that it was gold. It just happened to be gold. Now, moving on to silver. Same routine in silver. We saw the silver market come in and do a test of the 20-period moving average today. We knew the market was overbought up here. The 200 was going to be resistance. Did I know we were going to come down in 3 days all the way into the 20? Of course not, but we did, and it stands to reason that when a market runs into resistance and it turns around, there are times when you take those trades, and this is why I teach my traders and I teach anybody that I've ever taught. One of what I believe is the most efficient ways to place trades, whether it's stock and you're using shares or futures contracts and you're using contracts, I like to buy in multiples, meaning, for example, 2 or 3 even works, but 4. So, for example, if you shorted 2 silver contracts up and around the 200-period moving average with a reasonable stop, okay, and we would have had a reasonable stop because it was the 200-period moving average and it just wasn't going much farther, and if it did, then it was telling us that that wasn't going to be resistance to the market, and therefore we would have been, or I would have been wrong, and you have to stop out and move out of the trade. But above the 200 is the stop out in this example, right? It's not a real trade. It's a hypothetical trade that we're taking after the fact, so we know it worked. So you take the trade at the 200 with 2 contracts or 4 contracts or whatever the case is. Okay, if it's shares and this is a stock, it's 200 shares, it's 500, it's 1,000, whatever the number is. And once you're in the money by some amount, and every trade is different, so in this case, we'll just use, for argument's sake, we're just going to use 30 cents, right, in the price of silver, okay, or 20 cents in the price of the silver contract. You take one contract off, you have another contract at break-even stop or in the money stop, and there are times when that remaining contract or contracts just ends up going in your favor larger than you would have anticipated, and you get an early Christmas present, and that's just the way it works. And that's probably what would have happened with silver in a case like this. It happens from time to time. It happens on my gap trades. It happens on stock trades, on day trades. It just happens that way. Not every time. Sometimes you get stopped out on the second half. That's just the way it works. But when you catch those runners, you get the benefit of something like this, getting all that gain in a day like today. Another unsolicited trade lesson. Let's move along and go over to crude oil. And in crude oil, and by the way, I apologize for getting long-winded. It's Friday. And I know most people have better things to do than listen to me blabber on about the markets, get on with their weekends. However, as you know, I can talk about the markets all day and all night long, so I'm taking the liberty of adding some extra words to this video. I hope you don't mind. Crude is down here at a critical juncture, down around the $46 area. We're slightly below it. You can see when these doji candles are pseudo doji candles, anytime you see one of those, it's basically the market's way. I like to look at them as a signal at times. When we put in doji candles, certainly at highs and lows, much of the time it's a signal of a trend change at hand. But it's also the market's way of indicating indecision. And its indecision is the market basically closed and close to where it opened, and that's the indecision. There's no conviction of bullish or bearishness one way or the other on that particular day or candle or what have you. So when I look down here and I say, it looks like the market is struggling to find a low down here. That's the way I'm reading this. Doesn't mean it will find a low right away, but it looks to me like the market wants to find a low down here. Under normal conditions, this is what a retest looks like. You have a low put in, you have a big rally off the low, everybody thinks the low is in, and you come back to retest, and here we are within a stone's throw of the low from May 5th. And we're only removed 1 month, and we've taken one heck of a round trip in crude oil, but that's crude oil. It does that, and you can see it's done it before, and it's going to do it again. So I think that this low is going to hold, but we need next week to find out if I'm going to be right. If we put in a bearish pattern here, then I'm probably going to be wrong. We need to really, within the next day or two, we need to start getting up and going if this is going to get up and go. And if it starts to get up and go, it could get up to 47, 47 and a half, maybe even 48 pretty quickly, because if it starts to get up and go, the likelihood is it will begin to eyeball the top of this red candle, this breakdown candle, and that comes in at around 48. So it'll start to make a run for those numbers towards the top end of this red candle. And that's the way I see crude oil. If we put in a bearish pattern, then we're going to go down and test double bottom, and if we do, I'm not 100% sure it's actually going to hold. So we'll see. Need more time, need more evidence. Can't tell just yet. The bond market. And the bond market continues to trade in its bullish pattern in this upper range. And it's just interesting how we saw this big whoosh in the NASDAQ. So that type of down day in the NASDAQ being down, let's just call it 2%. The composite was down 1.8 and the NQ was down more. That kind of day, down almost 2%, would be indicative of the bond market rallying ahead of time. And I would have said, hey, remember I said the bond market guys are smarter than the stock market guys, and that turned out to be the case. That was the canary in the coal mine, the bond market. Well, we got a portion of that today with the NASDAQ being down the way it was, or having the type of sell-off it did, but the S&P was flat, the Dow was up, the transports were flat, the IWM was up. So it was a mixed bag out here, and you still have the bond market going sideways in an upper range, making bullish consolidation. So you know where my head is. There's still a disconnect out here, and there has to be some kind of squaring of the circle, I'll put it, in order for these markets to get back to a sense of normalcy, and we'll leave it at that. But right here, what I see is a bearish pattern that's building energy for another move higher. That's what I see in the bond market, and that means lower yields. When you look over at the dollar tried to make a run today, and it really began on the vote that occurred in the UK last night. So the British pound sold off, the dollar started to rally. Maybe this was the low we were looking for, maybe it wasn't. Any way you look at it, we're off the bottoms. It's a good sign. We kind of settled today around that 97 area again. You can see how important that number is. So we rallied higher overnight, came back down today to test the 97. Let's see if that was just a retest of the 97 and if we can rally higher next week. But you can see where we went today. This old high was 97.47. Today's high was 97.47. That's not an accident. That's not a coincidence. That's the way the markets work. They go to important numbers, they test, and then they either go through them, consolidate around them, or just beneath them to get through them, or they get rejected temporarily from them. And that's what we saw today. They were rejected from that number, but this was the first pass at that number. We haven't been here in a couple of weeks, so let's see what happens early next week. If we can consolidate in this range up here above 97, then that'll be building energy for another move higher. And then we'll start eyeballing the next area of resistance will be just around $98 or 98 cents on the dollar. So that's what we'll be looking for. It'll go in stages, one stage and then the other. So the next major area of resistance will be 98. Where do I get 98 from? You see these pivot low down here? That's the market telling you that that price level is important. Comes in at right around 98. Okay, so we'll see what happens following, some activity next week. And that's about the ball game. It's everything that I wanted to and intended to discuss tonight. So I will leave it there. Thanks for tuning in for another episode of Common Sense Market Analysis. I'm David Frost, My Strategic Forecast.